Hello, I'm Abhilash Narayan, investment strategist at HSBC. Welcome to the latest edition of India Brief, where we discuss our house views about Indian equities and fixed income markets. Now, the market sentiment has ebbed and flowed in the last few weeks. February began on a positive note as US and India finally agreed to a trade deal which lowered tariffs on Indian goods exports to 18%. Soon after that, US Supreme Court struck down the tariffs, only for the US administration to reimpose a 10% tariff, which would be increased to 15% in due course of time, using other legal means at their disposal. And since 28 February, we have seen the conflict in Middle East, which has raised geopolitical risks at a global level. Now, 45% of India's crude oil imports, 60% of LNG imports, and around 80% of LPG imports come from the Middle East. And hence, a period of prolonged higher oil prices and gas prices poses downside risk to India's GDP growth and upside risk for inflation. However, it is important to point out that the ultimate impact on Indian economy will depend both on the magnitude and the duration of oil price shock. Now, given all of this, we believe the Reserve Bank of India is likely to keep interest rates unchanged in its April Monetary Policy Committee meeting, as it's likely to adopt a wait-and-see approach to assess the impact of higher oil prices on inflation, which was already on an uptrend. So what does this mean for financial markets? Well, firstly, we retain our neutral stance on Indian equities. While valuations have eased given the underperformance we've seen in the past few months, we still believe that Indian equities remain vulnerable given the geopolitical risks on the horizon, as well as continued investor outflows, given that Indian equities offer limited exposure to the broader AI story. As a result, we continue to favor the more defensive large cap stocks over small and mid cap stocks. From a sector perspective, we continue to be overweight on domestically oriented sectors such as financials, industrials, and consumer discretionary. However, we are bullish on Indian local currency bonds. Now, we think that the bonds offer attractive yields both from an absolute and a relative perspective, and they offer low correlation with both equities as well as other global bond markets. We also believe that bonds will be more defensive allocation should a period of higher oil prices lead to a broader risk of sentiment. So we continue to view bonds as a key allocation in any well-diversified portfolio.